Good afternoon, fellow traders. Thank you for joining me today to another webinar in the Blue Sky Forex webinar series. Today we'll talk about the Fisher Transform and Commodity Channel Index, aka CCI indicators. Today's webinar is more directed towards traders who are really unfamiliar with those two indicators and maybe want to investigate what are these all about and how to potentially use them in their own trading strategies or just trading activities. Before I get into the material, I will quickly go through the disclaimer. So you would need to bear with me for a moment, but can you just confirm in the questions section whether you can properly hear me and see the presentation? Great, thank you very much for the confirmation. So bear with me for a quick moment. Contents of this material are provided by a third party, not Hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Forex assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way, our agenda today is really simple, really straightforward. I will first of all quickly introduce myself. We'll then talk about what is Fisher Transform. We'll see one of the really simple ways how to use it. Then what is CCI, and of course um, how you can use the CCI as well in a very simple way to make better trading decisions. Okay. So I am one of the senior traders here in Blue Sky Forex. We are an education, research, and trading group. We provide 24-hour trade support and analysis just to help retail FX traders to make better and safer trading decisions. And Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you become highly profitable currency traders. Okay, so what is Fisher Transform? It is a technical indicator. It was created by J.F. Echlers, and it's essentially an overbought, oversold indicator, just plain straight overbought and oversold indicator. With a small, it's not a catch, but it's a small perk over some other overbought or oversold indicators. But it is designed to determine or help the trader find potential reversal points in the market and just visualize them with the instinct and sharp turning points that are also reflected on the actual indicator as well. Okay. Now the thing is with Fisher Transform that it quite often gives you a trading signal before other leading indicators do. And of course, obviously it does so before any lagging indicators as well. And this is the reason why this indicator specifically has been quite endorsed by a lot of technical traders, especially lately. I'm not sure why it was just picked up lately more and become more popular, but it has been in the business for quite some time now. So yeah, it does look a lot like a stochastics indicator. If you just put the plain Fisher transform onto the chart, it will look like two lines and it will look like a stochastics indicator. Although most likely, like with stochastics indicator, there are many different ways how to formulate this visually onto the chart. But essentially, it's still showing the same thing. There might be some variations of this indicator, maybe some um, mutations to the actual formula, how this is calculated, and just rendered as a new type of indicator that's just derived from the original Fisher transform. But essentially, the very main principle and the purpose still remains the same, just to help you identify when the price is overbought or oversold. You can incorporate this indicator with other indicators as well. For example, like stochastics, RSI, MACD is something you can use with this. Ultimately, before I get into the one of the very simple ways how to realistically use it, like you see on the image below here, you have essentially these two lines. One of them is a main line, the other one is a signaling line. And you have visually drawn the buy and the sell signal here. Okay, so this is how it essentially signals any potential price reversal points. It will help you determine when is the best time to enter the trade. As with all other technical indicators, this of course should not be traded alone. You definitely need to create a strategy and incorporate this indicator into your trading decisions, or just build a strategy around this indicator. There's another option. And I would highly recommend just to seek for confirmation from other maybe overbought, oversold indicators as well. A wise thing to do here would be to first determine the overall trend and then trade the next impulse waves of the trend. And this is where the Fisher transform actually performs relatively well. When you have identified the main trend, let's say you have a trend going upwards, and you see the Fisher transform briefly showing you an extreme oversold state of the price, but the overall or the general trend is still going up significantly, then you might find yourself looking at a really good long opportunity and just to benefit from the next impulse wave of the trend, right? So this is how a Fisher transform comes into play. Now, a very simplistic approach how to use the Fisher transform strategy. We have just two slides. One of them is showing you a sell scenario. The other one is going long. So let's just analyze how to use this for a long trade. Okay. If you compare this Fisher transform indicator at the bottom of this price chart versus the one that I showed you earlier, you see a significant difference. Okay, this is a bit different than the one before, and this already shows you as well that this indicator can be visually drawn onto the chart in different ways. Some of them are a bit easier to read, some of them are a bit more difficult. But I find that this histogram version is relatively easy to understand and easy to read. Maybe a bit easier than the two lines method, but it's still showing the same thing, right? So How you could incorporate the Fisher transform in a very simple way. Okay, so first you have the moving average. This is the purple line on the price chart. We're dealing with an exponential moving average in this case because we want the moving average to be a bit more sensitive to the price movements. And this, of course, is used in relatively low chart time frames because this is a scalping method, okay? Because you will be aiming for these low pip gains with a really low pip stop loss as well, okay? So you can use this exponential moving average. On this occasion, we're using 5-minute charts, okay? You can also use 15-minute charts. That's completely fine. Maybe even 30-minute charts. But as we're dealing with scalping here, 5-minute charts is completely okay. So you can set the period of the exponential moving average to 20. Or you can just raise the period just a little bit to make it a bit less volatile. But 20 is, good enough for now, for starters. So you draw this exponential moving average onto the price chart, and depending on the side where the price is at, based on the moving average, if the price is above the moving average, we are considering to enter long trades only. So the short-term movement is upwards, okay? So in this scenario, we see the price being below the moving average and then passing over the moving average upwards, okay? Now, within a few candles of the price passing over the moving average, the Fisher Transform histogram needs to have passed from red or from below zero towards the positive side of zero. Okay, so essentially turn from red to green. Okay, so you see the histogram going from red to green. You see the price going from below the moving average to above moving average. And in this scenario, it's a relatively decent uh, long entry opportunity just to scalp for maybe 20, 25, 30 pips profit. Okay, so this is a really simplistic approach. This, however, is a bit different way how to use the Fisher transform to your benefit, because previously we explained that this is an overbought oversold indicator, which essentially it is, but this is a bit of a different approach and not really attempting to find these reversal points with the Fisher transform indicator showing the price being extremely overbought or oversold. This is essentially just crossing from one side to another, just signaling a new short-term movement forming. Okay, and this is just vice versa. And as you can see on this example as well, the Fisher transform is crossing the zero line, going from green to red. We have the price moving from above the moving average to below moving average, and again you have a short trading opportunity. So this is a very simplistic approach to using Fisher transform. To use or utilize the Fisher transform in regards to identifying the extreme overbought or oversold indicator statuses of the price, you should not only use the Fisher transform, but incorporate your own price analysis and some other technical indicators just to confirm the overbought oversold status of the price. Okay. So let's take a look at CCI, the Commodity Channel Index indicator. Now this is a momentum-based technical trading indicator, and this will help you determine when an investment asset or vehicle is reaching a condition being on overbought or oversold as well. So this is also an overbought, oversold indicator. Okay. However, a very interesting thing with this indicator is that depending on the market conditions, its function will change a bit. And also, depending the time frame of the charts that you will use, the way you can utilize the CCI indicator will also change just a little bit. And I will explain why shortly. Okay. So this indicator, of course, as the name says, commodity channel index, it was first developed by Donald Lambert for analyzing commodities. Okay. It is an oscillator. It is meant to measure the change in an instrument price relative to a predefined moving average of the price divided by 1.5% of a normal deviation from that average. Now, it might not make sense, but I mean, on this webinar, there's really no a need to get into the really core formulas of those indicators, because that really does not translate into your efficiency using that indicator, I believe. Okay. So you don't need to know the formula by heart in order to be able to utilize the indicator successfully. You just need to understand the core principle of what the indicator shows you, what it represents, and then develop or understand few methods how to utilize this indicator to make your own trading decisions. Okay. So knowing the formula is not really important. So you don't need to go into extreme technicals here. But again, it is an oscillating indicator. And as for all oscillating indicators, the current value of the indicator is usually just moving between two certain values. Okay, just two predetermined values. So for the CCI, the predetermined values, they can go higher, but usually they are 100 and minus 100. You can find values like 200 and minus 200 used, but still they are usually the same on both sides. Okay. Now the extremities of this indicator also shows you or indicates the price being overbought or oversold. So this is as simple as it can get. You can utilize this indicator simply for that purpose, just to find when the price is overbought or oversold. Okay. But there is a certain way how you can use this indicator on multiple time frames, and then you just need to understand how its function might change based on what chart time frame you use. Okay. So a very simple observation of this indicator. You are looking at right now a weekly chart, and this is important. You can see at the bottom the CCI is drawn. The period is marked down as 30. The default period should be 14 for this. I find it a bit too hectic. I find it a bit too volatile. So raising it up to 30 would make sense. It is better to visually analyze. And it's also reflecting on this image here. Now, as we are talking about this being an overbought, oversold indicator, this is true. However, if you go on a really large time frame charts like weekly charts and onwards, you will find that when the CCI goes into one extremity, then quite often you will see a relatively significant trend forming in that direction. And the CCI can remain in the overbought, oversold territory for quite some time while the trend is developing. Okay. On this occasion, sure, um, it was a relatively brief trend which you could have benefited from. Um, However, on this occasion, on the really extreme minus 350 territory, it quite bounced back, and as you can see, a lot of indecision here at this range. However, on this side here, you can see as the price moved across our 100 line upwards, which essentially should be already an overbought area, right? But you see at this point a really significant trend forming. From here to here, sure, quite good movements. If you have taken profit here and sit out this correction and then move up here, as the CCI is really quite often visiting the overbought extremity, um, a relatively significant trend was forming, right? You can use this also on daily charts and see if it works the same, but going anywhere below the daily charts, its function can become a bit different, a bit similar to the Fisher Transform, where you can find the shorter pullbacks and then identify when the next impulse wave might happen. Okay, so let's say you apply the next method. First of all, you will open up a large time frame chart. Okay, let's say a weekly chart. In this scenario, if you're using a CCI in this method, you should be a position trader aiming for these large gains and expecting to be in a trade for longer durations. Okay, one moment. Okay, sorry for the small delay here. Okay, let's say you use the CCI in the following method. You will add it with a period of 30, that's fine, onto a weekly chart. Okay, you see that on the weekly chart, this CCI shows a relative overbought state of the price. So on a large time frame, as said before, you can consider this as an indicator of a potential significant trend forming, a longer term trend forming. Okay. And then you go ahead and add the CCI on the lower chart time frame. The daily chart is quite in the middle there, but anything lower than that, maybe a 4-hour chart, 8-hour chart. If you have 12-hour charts, that's fine. Even down to 1-hour charts, but that's the minimum where I would go with this. Okay. Let's say you put it up to a 4-hour chart, which is also available in MetaTrader 4. So what happens is that on the large time frame chart, this CCI shows an extreme overbought condition, hinting that most likely you have a proper trend forming for at least a week or 2 or 3 or 5. And then on a 4-hour chart, you see that the CCI is in the minus or in the negative area, showing extreme short-term oversold condition of the price, right? And as the CCI starts going from the oversold status towards upwards, that is a hint that the price is, nearing its next impulse wave. And you can go into the long trade. So this is an approach that can be taken when using CCI. Again, this can be used along with other technical indicators. Most technical indicators can be used in conjunction with each other just for confirmation purposes. But please be advised that a lot of technical indicators, especially the overbought oversold indicators, they show you the similar thing, but just put together in a bit of a different formula. Maybe visually they look different, but it shows similarly the same thing, right? You can, of course, look for confirmation between several different overbought oversold indicators and then make your trading decision. That's completely fine. But relying yourself too much on expecting all the indicators giving you confirmation and then only then entering the trade, you're really limiting yourself. So don't go too far. If you see all of those overbought oversold indicators or some other technical indicators that show you momentum or show the direction of the current trend, etc., then it's good to go, right? So two really straightforward, simple ways how to use the Fisher Transform and the CCI indicator, and essentially what they show on the chart itself. They're both oversold, overbought indicators, which help you determine the state of the current price, but they can use differently, especially CCI if you are adding it to a longer term chart or and a lower time frame chart. Okay, so you can just combine them together and use it as that. Okay, let's also talk about quickly the currency trading dangers in overall in trading. If you can, please try to refrain from using any expert advisor or bots. Many of them are designed to generate losses on your trading account, so be extremely careful. If you decide to use any of them, please do so on a demo account. If that certain robot or whatever system that is placing trades automatically in behalf of you on your account, if that system is able to generate profit on your account consistently through longer term periods, like 4, 5, 6 months, then you can go ahead and set it up live on the live account. But please use really low lot sizes and just trade as safe as possible. Okay. Now, sad but true, but only 5% of the retail traders make money longer term in FX. And the reason behind this is it all boils down to our brain, right? Human psychology. We do have a separate webinar on that topic as well, just to explain a bit in more depth what exactly happens in your brain when you win or lose. But essentially, if you are on a losing streak, you tend to start over trading revenge trading. You just want to earn back all the losses that you have made this far, and you start making more silly mistakes and maybe emptying your account. On the contrary, if you're winning a lot, then you have a lot of adrenaline flushing through your veins, and you will start over trading because you feel invincible and you want to earn more. You feel like you cannot lose if you are on a winning streak. And this can also eventually result in you making silly mistakes and either losing all the profits that you have earned that far, or even generating some losses on your trading account. So in order to be successful longer term, the very most important thing I would say is to be able to manage your emotions, follow the rules of your trading strategy. Of course, develop a trading strategy at first. That also takes a lot of time, a lot of patience. And just stick to those rules. If you stick to those rules and follow your trading strategy, you will be able to, of course, determine whether that trading strategy is successful or not. If it is at least even slightly successful and you keep on following those rules, then you will be successful longer term. The next thing is that emptying one or two accounts is not completely a bad thing. It generally is a part of every trader's journey to eventual success. However, I want to be extremely clear here that emptying or blowing up one or two accounts does not have to be a part of every trader's journey. It does not have to be. It's better if it's not, right? But it's likely that at some point when you are learning and when you are developing a strategy that you will empty one or two accounts or one or two deposits. And that is completely normal. And another thing is that if you do end up losing your total account balance on one or two accounts, that does not necessarily guarantee that you will be successful longer term or after you have emptied those accounts. Okay, it's not a guarantee that you will change, that you will be able to change your trading and your strategy and how you actually approach your trading in overall. Okay, so these are the things that I wanted to mention, but this is a part of most of the trader's journey. I also have empty one or two accounts. Okay, but this made me learn more, improve myself, improve my strategy, improve my trading habits. And in order to improve your trading habits and how you approach trading is by keeping a journal, and this will help you analyze yourself and your trading habits. Now just take maybe 15-20 minutes after each trading session to mark down exactly what you did, how many trades you initiated, how many trades you lost, how many of them you won, what was the total pip gain or loss, and what session did you trade at, how long did you trade, and so on, so on. So as many details as possible, just document them down, analyze your trading session 15-20 minutes afterwards. And if you keep on doing that, eventually you will build up a quite fulfilling journal. You will be able to analyze your own trading habits, what exactly you are doing. And if it's not really working out for you, then you can take this journal, you can start making adjustments to a few aspects of your trading, maybe change the session you're trading in, maybe change how many trades you usually initiate per trading session. If you find yourself initiating maybe 10, 15 trades and you're losing most of them, then it might be that you're not really putting enough time to every single trade. You're not analyzing your trades enough. Okay? Maybe that means that you need to spend more time with each opportunity before you enter the trade just to find the causes why you want to initiate the trade, and also find the causes why you wouldn't want to initiate the trade, and just compare those together and see what overwhelms. Okay? So just as an example, keeping a trading journal is really, really essential to eventual success. Again, this doesn't guarantee that you will be successful, just to want to be blatantly clear here. But it all depends on you, right? Your ability to analyze yourself and your own trading habits. And of course, setting strict rules and keeping to those rules. Last but not least, only 5% of signal services and signal rooms are legitimate, so please be extremely careful before engaging in one of those. If you decide to try out one of them, please do so again with a demo account. If you see that by following these signals or these recommendations or suggestions will result in your account capital growing over longer term, only then decide to or consider using a live account with these signals. Before doing so, please ask for a proper performance and audit trail, a performance record and audit trail. If possible, ask for opinions or feedback from any other participants, any other users, what their experience has been, if they have been able to grow their account capital without any large drawdowns by following the advice from those signal services or signal rooms. And if everything seems okay, then just test it out. Okay. But again, please be extremely careful with any robots or systems that initiate trades in behalf of you, or following anyone's trading recommendations online. Okay. The best trading indicator or the best trading tool is yourself. Okay, please keep that in mind. And the best trading indicator, again, is actually the price itself. Okay, so it doesn't have to be some formula-based, visually analyzable or readable, a line or histogram or anything like that. Because those are still derived from the price itself, right? So the price is the really, really core indicator of everything. This is the one that you should be analyzing the most. Okay. So this is it for today's webinar. I hope I was clearly to the point. I hope I was able to provide you with some insight about those two indicators and just very basic ways how to use them. Let me then open up the question section. I will answer as many questions as I can. If anything remains unanswered, then please don't hesitate to send them to webinars@hotforex.com later on, and they will do their best to answer it from their side. One moment.